All right, I've started this. You want to go ahead and kick us off, Ken?
Good evening, everybody, and welcome to the December 2022 Roundtable. This will be our last roundtable in 2022. We're more than happy to have you with us this evening. We have a real nice registration for this wintry evening between Christmas and New Year's. I'll be joined this evening by my good friend Mark Robertson, who is the Chief Operating Officer of Manifest Investing. I represent the Better Investing Mid-Michigan chapter, and we've been co-sponsoring this event now for going on 11 plus years. We happen to have Cy Lynch with us this evening from Atlanta. Cy is one of our regulars. He's a knight of the roundtable. He's chairman of the NAIC Board of Directors, and he's a longtime volunteer for Better Investing. And we hope to have Hugh McManus with us. Hugh lives out in Pasadena. Hugh is a past president of the Volunteer Advisory Board for Better Investing. And Hugh is just an all-around interesting, fun guy to speak to and to listen to on a regular basis. So not that, Mark, not that you and Cy aren't fun guys also, okay?
I was about ready to be insulted, but
I think you just called us fungus, Cy. Fungus.
fungi, huh?
Hugh is a joy many times to listen to because he always has a slightly different take on the kind of things that we do as investors. Mark, if you could go to the next page, we can go through our disclaimer really quickly. This is an educational demonstration, and we're not making recommendations to buy, sell, or hold any stocks. We're going to talk about a lot of stocks in real time. We'll try to remind you if we own them in our own portfolios, but essentially we're trying to make educational points as we bring them to the roundtable to speak about. If you'd like to be reminded about our monthly roundtables, we send out about 1,000 emails each month to our guest list, and my wife would be happy to add you to the Mid-Michigan guest list, and we will remind you once a month about when the roundtable is coming up and provide you with a link for registration. We also will provide copies of the slides. If you would like copies of the slides, just try Mark R at manifestinvesting.com for copies of the slides. Mark and I both answer questions all month long about the roundtable. So if you have a question or a comment or would like to start a chain of discussion points, feel free to drop us an email, and we'll try to include some of those things as we move through our roundtables. We're real pleased to have been doing this for as long as we do it. And let me explain what exactly the program is. We have a standing agenda where we discuss stocks, and the basic goal of the roundtable was at the beginning and has stayed the option of one of us each presenting a single favorite actionable investment stock to the group. So we're going to have 3 people here definitely tonight, so you'll hear 3 different presentations on stocks that we find compelling at the moment. That doesn't mean we'll find them compelling in a month, and it doesn't mean that we found them compelling a month ago, but we like them right now, and we're going to try to tell you why we like them right now. We're going to make some challenges to stocks in our tracking portfolio. We're going to show you our results. We're just not afraid to publish our results and keep you aware of how the portfolio's doing over this almost 11 years. You're going to hear about Adobe. I think this one is called TTEC Holdings. It might have been known by a different name, but I think it's using the letters right now in its name. We have a logo up here that says TTEC, and Mark is going to talk about TREX. We'll also allow you to pick one of the three and add that as a position to our tracking portfolio. And then, like I said, we'll try to get all of your questions answered before we finally leave the session. I can't guarantee that we will, but we'll do our darndest to make that happen. Mark, have I covered everything up to this point? What do you think?
Yeah, I think we're fine. Let's keep rolling. I actually added this one to the deck. I'm interested to hear Sai's reaction to some of this. We talked about this afternoon during bull session. This is kind of a page that I track principally to track the performance of the Tin Cup demonstration portfolio and then some benchmark references. That's where you see all the 1994s. But what you're looking at is a list of some index ETFs or index funds or mutual funds in combination with a couple of portfolios, including the roundtable portfolio and the stocks up at the top. And those are not just simply chosen at random. The dates are a little bit at random. I just wanted to go back and cover a pretty lengthy time span of 4 or 5 decades in some cases. But those stocks up at the top are the most widely followed companies and most widely held companies by people in this audience. And I think this page basically says, this is why we're here. This is why we try to pick stocks. We try to find excellent companies with exceptional return forecasts and hold them for as long as it makes sense to do so. Your thoughts, Ken, and then Sai.
Well, this afternoon I shared with everybody that I own stakes in all 5 of the top 5, and I would imagine that anybody that's in the better investing community owns 3 or 4 or maybe all 5 of them. Stryker certainly is an all-time favorite, as is Coke as well. So you don't need a whole lot of these stocks performing at 20% plus to keep a portfolio chugging right along. I don't know what else to say except that I'd rather have 20% plus rather than 10% minus by being an index investor. How about you, Sai?
No, I think it's an interesting chart. I would probably just see if I to deep dive it, figure out if there's any significance to a few of those dates, like you were alluding to on the holdings, Mark. But I do find it interesting. I think right now I have owned all of the top 5 except Apple. I think I currently own 2. I don't think I own Visa now. I have owned, no, I own Fastenal now. So I own 3: Microsoft, Fastenal, and Cognizant. But the big thing that strikes me clearly are, look at the bottom of this chart, and again, 7.8 to 10% is not any particular shabby return for almost 30 years. But the roundtable, the Tin Cup, and community favorites have blown all of those out of the water. So
yeah, one of the things we pointed out this afternoon is you take this value line arithmetic average, which is, again, the companies in the value line standard survey. And we refer to that as all of the above because you have a blend of small, medium, and large companies. And just notice that among the aggregate investments here, it is the top one. Mm-hmm. And 11, like Sai said, 11 is not shabby. And then we've also spent some time with the medium-sized companies this year, and that is amongst the leaders amongst those types of companies. But the other one that we talked about briefly this afternoon was Neogen. It's a community favorite, pretty much in the upper Midwest, Michigan, and whatever. But the story of Neogen has spread nationwide. And despite a 67% year-to-date loss in Neogen, you're still looking at a 10.8% return over here. And Ken asked me to double-check the numbers, so I did. So we'll go into that in a second. But wow, I mean, it's really a neat story. And the Coca-Colas are there just for the reason of pointing out, Buffett is infamous /famous for taking a very large stake in Coca-Cola after the classic Coke test that failed in the mid 1980s,
Hmm.
and the motion picture studio, which failed in the 1980s, and basically it was not doing very well in the late 1980s. Buffett takes a big position. That's how well he's done. Well, Nicholson got there 15 years before, and
Yeah.
he basically he used Coca-Cola as the centerpiece of a series of pieces documenting the triple play, screening technique. And I just think, well, both of those numbers are not too shabby.
We have a hand in the air, Mark, and I like to recognize those people because it takes a certain amount of guts, I guess is a good word, to put your hand up at something like this. So Jennifer B, you're muted on your side. If you'll unmute, we'll listen to what you have to say. You do have to unmute on your side, though, Jennifer. I can't unmute you. Okay, I'm going to assume that's an inadvertent hand then. I'm going to take the hand down and let's continue, Mark.
Okay, so again, encapsulating the theme, again, the roundtable as a demonstration, we do not compare notes. We come every month with ideas and we keep track of them over time. We'll take a look at the track record in a little bit more detail in a few minutes, but I do see this page as a kind of a compelling motivation or inspiration for attempting to invest in excellent companies at better prices. So it's kind of cool. And then this afternoon we talked about Neogen. Could that price drop really be true? It is true. But I kind of find Neogen compelling. In fact, I did at least 2 laps around the track thinking about bringing it as a roundtable selection tonight, under that same old theory that this is a company that still has up, straight, and parallel lines for the most part, and they are going through a structural upheaval in the merger or joint venture, whatever the thing is that they're doing with 3M. And I know many of you out there know much more about it than I do. But the question, there obviously is some question about their joint enterprise with the 3M food safety division. So it's really kind of a compelling study, and I think many of us will be kind of raking it over the coals here in the next couple of days. Notice that Value Line still has a very favorable outlook for the company. So does that take care of your questions from this afternoon, Ken?
For the most part, Mark, yeah, let's keep moving.
Okay. Well, here's a look at the roundtable portfolio over the years. What we are graphing here is the relative return, which is basically a measure of outperformance for the portfolio. We're comparing the portfolio's performance, the tracking portfolio performance, versus the Wilshire 5000. And you can see the numbers here, 14.5% over that basically 12-something year time frame, versus mirroring investments in the Wilshire 5000 at 9%. Simply one minus the other gets you to this 5.5, which is a new recent high. That's what's graphed right there. So we are literally graphing the amount that this tracking portfolio has beaten the market from years 3 through 12 and change. The dotted line across the middle there is the traditional investment club objective to beat the market by 5%. And again, I think we should pop some New Year's Eve champagne early and just acknowledge that it's kind of nice to have a 5.5% relative return.
I always feel better at the end of the month, Mark, when we've bounced upward rather than bounced downward. I don't know why. It just makes me feel good. So I like to see that up above that dotted line, and I like to see it up about 0.5% from where it was just a month ago.
Well, you start sinking and you start thinking quicksand and hope for the best. Yeah. All right. Here's a look at the portfolio. We do keep the tracking portfolio on a public dashboard. You can reach that link at the bottom of the page. What you're looking at here are the top 20 holdings by percent of total assets or by the dollar value of the positions. every time we make a decision, whether it's a knight, a guest damsel, or the audience, we invest $1,000 into that company. So in the case of Microsoft, this is how you use the legend up at the top. Microsoft has been selected 5 times. See, it appears up here. So $5,000 has been invested in Microsoft. That $5,000 is now $60,000. And we shake our heads over that and enjoy that. And you can see for many of these positions, EPAM has just been on a rocket ride. Thank you, Cy. What a wonderful story. EPAM has really hung in there despite the challenges in Ukraine, and seem to be firing on all cylinders. Anything jump off the page, Ken or Cy?
I'm glad, Mark. We had a couple different opportunities to look at booking and to move away from booking during the pandemic. And I'm really glad that our decision was to stick with it, that it certainly was going to be a good business once people started traveling again. And those 11 holdings, that $11,000 is almost doubled now for us. It's certainly moved up the chart pretty emphatically in the last 3 or 4 months. I'm just so happy that we were aware enough to say what was happening during the pandemic was not going to be the trend for this company going forward.
Any thoughts, Cy?
Temporary or terminal? I mean, that hits booking. It hits EPAM, although that was a toughie. But the lesson that I get from EPAM that I use, and I say this in classes talking about the temporary or terminal issues, referring to business challenges. And of course, EPAM has much of had a significant chunk, over half of their programmers and operating business entities in Ukraine and a little bit in Russia, but mostly Ukraine and other Eastern European countries at the start of the Ukrainian war. But what I always encourage people to do, and I always try and do, is when management, first of all, does management recognize the problem? And clearly they did. And does management have a plan? And Ukraine or EPAM's management was very upfront. Said, we obviously have major problems, and here's what we're doing about it. We're doing the best to move our Ukrainian workforce to parts of the country or to other countries where they're safe, and we are recruiting replacement employees in other parts of the world. And they have done well.
I have a pretty large personal holding in EPAM, Cy, and what stood out for me was their willingness to make these statements and to make them not just once, but to repeat them often enough so that you had faith that what they were saying was going to be what they were going to do. I'm in an investment club that took their EPAM holding and almost doubled down on it, bought another chunk, about 90% as large as the first chunk, because of the idea that we thought the management was talking to us honestly and openly, and it sounded like a plan that they could make succeed. The other one that sticks out to me, Mark, is the fact that we haven't just automatically bailed on our home builders either, just because of the housing problems at the moment. I'm looking down the list at LGI Homes, which has been chosen 6 times. It's a little bit under a double right now. It was a little bit better than that, obviously, maybe a year ago. But still, where that holding is today is really pretty decent. And the par value going forward, it's a little bit anemic at 7.6, but it's nowhere near where we should be deciding we're going to bail on it because it doesn't have any chances of return. I look to see that par number begin to go back up again as interest rates stabilize and then maybe even begin to come down a little bit. Interest rates have come down about 0.5 to 0.75% in the last 4 or 5 months, and the trend seems to be in the right direction at the moment.
Yeah, I think it's a great example. We're going to take a closer look at the discretionary sector here over the next month or so, and also focus in on an industry study of residential construction. So I think it'll be interesting to take a look at that. The other one that I wanted to point out to the audience is Costco's been purchased once, and $1,000 is now this. And Costco's been pretty formidable over the years. So again, you can look at the whole portfolio using that link at the bottom.
And that's our only regret, right? Only purchasing it once.
Yeah, we've talked about buying it a couple times. We should do more than talk.
Yep.
All right. So right now the average stock, that's what my par is. The average return forecast is right at about 12%. So we're looking for companies in the 17 to 22 range to add to the portfolio. That's just simply companies that are in our version of a buy zone. The overall portfolio has 14% growth. Financial strength at 80, that's pretty good. Exceptional quality, good quality, and the par is a little bit low. So hopefully we can continue to add to that and kind of crunch on it as time goes by. Here's the challenge. Go ahead.
I'm gonna make a suggestion, Mark, that we begin this challenge by saying to ourselves, Aflac's had a really good run. It's treated us really well for a long period of time. I think maybe the first holding of Aflac in this portfolio came from me, but at a par of 2.1%, and with our par still lacking the sweet spot by, I don't know, a little bit more than 2%, I'm going to suggest that 3.8% of our portfolio be frozen at where it is, and that we essentially it's selling Aflac. It's a different kind of a thing because this is a tracking portfolio, but I'm going to recommend that. To be honest, I don't care too much about the other 4 because they don't represent that much of the portfolio. I really, really like what Lockheed Martin has been doing recently. I have great faith that that bank is going to turn itself around and that that's a low par for that bank. And I could make my motion include Gilead and Strayer if you want to, because I think both of them have gotten a little bit over the edge of their skis at the moment.
I think our first order of business is being Aflac is a Georgia company. Cy, do you need an oxygen mask for this, or are you going to be okay?
Well, you talk about sacred cows or whatever being Georgia, and I was trying to remember. I may have sold Aflac out of my Better Investing magazine portfolio. I know I've thought about it in the last few issues. But,
that's heresy.
Yes, but I believe that 2.1, it's been a good run.
Yeah, we can always buy it back.
Right.
The other thing I would point out, and this is a fascinating speculation from Hugh McManus, maybe we can get him to talk about it if he joins us later, is he talks about if a cure for cancer is actually achieved, what would, he says, just think to yourself, what does that do to a company like Aflac in Japan? And it's a fascinating thought experiment to do because obviously they have massive reserves built up to take care of cancer in Japan. So interesting. And the other one that I wanted to point out is I think I've been at the center of a couple of successful transactions, round trips on Strayer over the years. And when Ken used to talk about me being on the railroad tracks tied like Snidely, Whiplash, and Nell and the oncoming train. And this would be yet another successful round trip with strategic education now, Strayer. So I would be in favor of those two going away. I think we should hang on to these because I don't think that 5-6% is anything to sneeze at.
Hmm.
And
No,
go ahead.
no, and I was going to say, I think that banks generally are decent holdings right now, and of course we heard last month from our bank examiner guest that banks are good too, and I've not looked in the last month or so at First Financial, but I don't recall it. It's just held up. I mean, I think it has generally done pretty well. That's largely a performance related
It
par
it is.
decline.
Yeah, I own First Financial Sign,
Yeah,
and you're absolutely right that the lower par, lower than a lot of the banks, is directly related to the fact that it's been performing much better than many of the
of
banks.
the banks. Yeah.
Yeah.
So it's not that there's a problem with the company that they're trying to overcome. So
All right, so let's go ahead and jettison Aflac and Strayer, and we can continue to watch for opportunities in Aflac. Gilead is kind of a special case. I'm not so sure I really have a lot of confidence in this number. Gilead's problem is they keep putting themselves out of business by curing diseases and not becoming a perpetual cash flow stream. So the hepatitis being the biggest example.
Yeah, I can live with those
the
two. I can live with dropping those two, Aflac and Strayer. Yep.
Let's do that for now, and we'll come back and revisit in a month. So let's go ahead
Okay.
and move on to this one. The rule of five is basically something we came up with to kind of trigger us into analyzing companies that are actually underperforming the market on a relative basis since the time of selection. So you basically are looking at a shorter list, thankfully, here in the last few months. But Generac is quite a mystery because that was clearly one of the best selections in the history of the roundtable when it was made.
Did you make that selection, Mark?
I had a co-conspirator and the
Okay.
audience also.
Right.
So I think we nailed it, but for some reason the stock market's not cooperating. So I don't know, Ken. I mean, it's not a hard and fast rule. I think that being nudged into thinking about, is something wrong here? We talked about a little bit before the program. This is not an iconic brand moment, in my opinion. I do wonder, is it a case of Fossil where we were stubborn for far too long with Fossil? What are your thoughts?
Well, luckily, all three of those holdings look like they came on the same purchase date.
They did.
So we had a couple different people making the first position, and then the audience took one as well. I'm still saying that I think it's time to say goodbye to the 3 Generac holdings and to the PayPal holding. I want to hold the MKS Instrument holding because we have other MK Instruments holdings that have been doing better than the 31.6, and I'd like to I just think that I don't want to split those holdings up. Let's keep them all. We have some. If you look from last month, you see that this particular one was doing 37.7 negative at that particular time. So it's improved a little bit. But I'd like to get rid of the 3 Generac and the PayPal, and then we always have the option of coming back to Generac and PayPal if we see something happen with earnings. But right now well, you have a graph, in fact, for Generac. Right now it appears they've pulled a lot of their value forward into 2022, and I'm looking at sales that maybe are going to go flat 2022 to 2024. So I'm suggesting that it's and again, trying to move the par in the aggregate portfolio up a little bit. I'm suggesting it's time to move those out of the portfolio and save whatever capital we have at that point. And again, because it's a tracking portfolio, we're not actually saving capital to reinvest. It's not like a real portfolio that you would run for your club where you can reinvest whatever's left. We're just freezing the holding, but I wouldn't like to lose any more. I think we've lost enough on all 4 of those holdings.
Yeah, and I think the big mystery with them, first of all, there's a nagging question: are we missing something here with the market? You know, what's going on in the? These are not small generators; they're big generators, but residential, commercial, industrial. What's going on here? I do think Value Line is probably out to lunch with their longer term operating income and their bottom line here. I don't think that's going to happen. I think it is a pretty tough competitive environment. So this number's inflated.
I did go back, Mark, to the most recent investor's manual that I have in hard copy. It's not the one we usually use, which is from the 80s, which we think Nicholson had a lot to do with. But it's the last one that Better Investing passed out to new members that was in hard copy. And I did review kind of the rule of 5, and the sentence that stuck out to me was, many times you can't figure out what makes that 5th one not perform the way you want it to perform. Many times it's impossible to decide. You look at your analysis and it appears to be everything's correct, and yet it's not performing.
Yeah, I actually think it's just the great humiliator trying to wreck my day. He does it from time to time.
Could be.
Yeah, I don't know. This one's bizarre to me because it made a lot of sense at the time, and I'm not going to give up looking at what may have gone wrong. But you're right. I mean, one of the things we're taught about the rule of 5 is that sometimes you can do a great analysis. You can have a red S on your chest, and you know, basically do everything right and still have it mess up. So, without belaboring the point too much more. Cy, you okay with jettisoning a couple of these?
Yeah, I'm fine.
Okay.
I have no problem with that.
All right. So with that, there's only a couple others that get flagged a tiny bit. Ardelyx has been red hot. Come back in 2 months when we're handing out trophies. That's a little foreshadowing, because I have a position for the roundtable at 57 cents back in June on Ardelyx. And that actually got up to 246 today, everybody. 246. So
I'll tell you, if things hold the way they are, you're going to be insufferable next November at our stock pickers breakfast. I always tell people when you're down near the bottom, Mark, and I will tell people that Mark's portfolio in the Mid-Michigan Stock Pickers Contest has moved him up to 2nd place at the moment on the back of Ardelyx. So we'll see whether he's still there in November, but right now he's riding high.
I might have to cash out on that one. We get to do transactions there. So again, it's been hot. The nutshell, maybe Hugh could give us a comment on it if he checks in later in the session. But again, the thesis is intact. They are actually staffing up for what appears to be a phase 3 release by the FDA. So their kidney dialysis treatment for patients appears to be on a track that has a possibility of succeeding. And that would be a massive event. People who watch this type of thing can see a company with a market value of anywhere from $8 to $20 virtually overnight, based on the potential for that solution. So we'll see. It could also be zero. So that's tough to take. The other one that is a potential buy right now that is one of my picks, Sirius. This is actually a market-beating selection for the roundtable, and it looks to me like it's kind of back where it was with the October lows. So that's just kind of an interesting study right now. I might have to dredge that one out and take a look at it.
Mark, I want to draw your attention to a comment that Sean Mace has made during the evening here. He says that the competition for Generac is coming from Tesla, and that they have whole house battery backup systems. Is this what you were referring to with the Ford F-150 and the Tesla cars and everything that are able to do that?
Yeah, exactly. I think with a residential backup power supply, these are not cheap. These are formidable machines, these Generac power generators. Um, I just think that people are beginning to ask the question, emergency backup versus, as Sean has done, he's completely fitted his house with solar panels and backup battery power. Um, I just think that is a big competitor, and the stories are pretty widespread about the F-150's capability.
Right?
Also, go ahead, Si.
No, I saw Sean's comment about Tesla, and I immediately thought of the F-150 as well. I mean, it's certainly not as potentially long-term, extended use solution as a Tesla and some of the battery backups would be, but primarily you're looking for a relatively short-term residential solution, and the
Exactly.
F-150 truck does just fine from what I understand. So,
Yeah, run the refrigerator and run the laptop, and you're in pretty good shape for many
yep,
people. Yep.
yep.
So that's some of the stuff that we'll take a closer look at. So with that, I really don't know how the slide. I cannot seem to delete the slide, Ken.
Just keep moving here, okay?
Portillo's. If anybody's near Portillo's, please support that stock price.
Okay.
Buying a hot dog. Go ahead, Ken. Adobe.
I'm going to present Adobe. It's been presented a couple of different times recently. I chose to take this melange, if you will, or this groupings of different awards that Adobe has won, and you can read them as well as I have, but they're certainly sitting on a lot of different lists that use the word best. A lot of stuff out in outside the U.S. on the right-hand side of the slide. This is a highly regarded company, fast-growing, very innovative, and treats its employees quite well. If you listen to a lot of the different magazines and associations that are giving out these awards. Next slide, if you would, Mark. I started looking for a stock. I wanted to improve the portfolio, and these are the same numbers that you've seen from Mark for the roundtable portfolio. My par is the return for an average stock in the database at about 12.5%. And then the sweet spot is 5 to 10 percentage points above that. So we're in the 17.4 to 22.4 area. Our par is 15.4. That's about 3 points better than my par, but it's still not to the sweet spot. And I'd like to increase par with my choice. So I say to myself, let's look for a stock with a par bigger than 15.4. That was the first thing I was kind of after. And then to help boost that, I thought to myself, the way you boost par is you boost sales. So I was looking at the 14% overall sales growth for the portfolio. And I said, let's look for a company that can maybe go at even a higher sales growth than 14%. When I finally finish the analysis, you're going to see that my numbers actually undercut the numbers that I set as my original goals. But at the same time, I think that Adobe will be a strong addition to the portfolio. I did recommend Adobe back in December 2020 at a price of $498.95. And we did close that position between then and now. Monday, Adobe was trading at $338.45. You can see that there was a considerable change in the value, the dollar value of one share of stock. But let's not belabor that. Let's move on and look at Adobe itself. Next slide.
So if you liked it at $4.99, how could you not like it at $3.38? Okay, I said it. Go on.
So I was fascinated with all the different products Adobe has, and when I go to their website and look at some of the different presentations they put on, I am especially drawn to their investor presentation, which lays out Adobe's growth strategy in about 80 or 90 different slides. And there's such a large number of slides because what they're looking at are that many major products that Adobe deals with. I've just pulled the highlights from a couple of these. The Acrobat, Adobe Acrobat, which many of us are very, very familiar with, and with some of us actually use. I just was flabbergasted is a good word with some of these growth numbers that are capturing Acrobat right there. Greater than 50% year-over-year growth in PDFs opened on the web in the last 12 months. Did you read that number correctly, Ken? Well, I went back and read it again. Yes, it was greater than 50%. And I'm already thinking to myself, well, I probably opened 500 PDFs over a year's time, and they're telling me that PDF openings grew more than 50% in a single year. Greater than 60%, the share of Acrobat paid subscribers from product-led growth in changes in 1 quarter. That's 60% growth in a single product. So I was pretty impressed. Next slide. I'm looking. That's the same slide, Mark. I don't know why I have a double on it. Go to the next one. There we go. I went to another product, and I told you there are literally dozens of products where they're showing me tables and statistics about. Here's document cloud adoption through direct sales, and I'm looking down the right-hand side and I'm saying to myself, well, I know most of these companies and I know what they're doing, and I'm reading the bullet points underneath the picture, and I'm actually understanding what's happening with this document cloud. More and more companies are choosing to put their documents into the cloud rather than to hold them on servers within their own computer room or building or whatever. They're going to the cloud. Next slide. Use begets use came to mind. I've heard that said about a number of different companies, but as companies begin to use some of these other things, you're unlocking workflows by using more and more PDFs. 140% growth in developer PDF signups. 15 times year-over-year increase in PDF transactions, okay? And again, you can see some of the customers and some of the partners Adobe is with. Adobe is really nice to a lot of different companies and complements what companies do rather than competes against what companies do. They make that point on a lot of the different things that you read about the company, that they're there to help companies unlock efficiency, to help employees become more efficient at doing whatever their job happens to be. And the more you use Adobe, the more you tend to use more Adobe products. Next slide, Mark. This is a duplicate. I don't know what happened to my slides when they were translated. Go, next slide, Mark. Next slide. Some of the cloud drivers can be read in the black band in the middle. And there's the same general strategy for any Adobe application you can think of. The more they can get you to use a single adaptation, the more they can double and then triple and then quadruple your usage into 2 or 3 or 4 or more products. Next slide. Next slide, please. Thank you. Their strategy works because customers are comfortable with Adobe. 92% of marketers, and again, the percentage is just mind-boggling to me, but 92% of marketers view video as an important part of their marketing strategy, and they're using Adobe to create these videos. Small businesses, greater than 90 million small businesses, are moving to social media platforms. The growth in the retailers using virtual shopping, 260%. And these are from relatively mature markets. It's not like from a market that started out with 10 users and then went to 40 users. It's like it's from a market that was relatively mature to begin with. About 200 million individuals using Adobe to influence, to create, to aggregate, or to monetize their audiences. 200 million individuals. The population of the United States is about 350 million, by the way. Next slide. So we look at the pictures. I've added the estimates coming from the Morningstar data feed. Those are the 3 open dots you see over 23, 24, and 25. I've used sales projections and earnings projections, which take me fairly close to those analysts' estimates. Value line, that little box in the bottom center, is from Value Line. Value Line seems to have estimates that are as optimistic as Morningstar's. I like the fact that Morningstar says 14 5-year earnings estimate, and Value Line says 13.5 5-year earnings estimate. I really like it when my 2 main trusted sources end up being that close together. Value Line, a little bit more optimistic on sales. They're at 17%. Morningstar at 10.5%, 10.4%. But all in all, I think that the IBARs, the most recent 3 years, which show a decline in price, I think are going to be moving in the other direction as you see this nice steady growth in sales and then a continuation of growth in earnings. Next slide, please. I've estimated sales at 10 going forward and at 14 for earnings growth going forward. Note there's a red warning for return on equity, but when I look at the actual numbers, it's 32.7 compared to 33.4. I'm not especially upset about that, and I've always been teaching others that when you get return on equity well into the 20s and 30s, you're looking at a superior company as far as the numbers are concerned. They're doing it with a very acceptable debt. Just to keep everything on the up and up, I went and looked up their interest coverage in the most recent year. It was 50. Remember, a warning sign for interest coverage is when it gets down into the 5 or 6 area. Adobe's most recent number was 50. Next slide. I'm expecting PE ratios to continue to contract until the Fed finally chooses to kind of put a pause on what they're doing with interest rates. So I chose 40 as my high average going forward. Compare that to the 5-year past average of 58.4. I'm really compressing that high PE ratio. I chose 25 for the low and compare that to the 5-year going backwards of 31.8. Didn't compress that one quite as much. The value line price, when I'm looking at the value line report, was at $316. It's a report that's about a month old. So Monday's close at 338 is certainly an improvement over where it was when you read its value line report. Next slide, please. And there's what Value Line had to say at that lower price. Right there in the right-hand side, Adobe stock is timely, and then you can read the rest of it for yourself. Notice that Value Line is suggesting 16 to 26%. I think I'm doing an extremely conservative SSG, and when I close my SSG out and get projected return, that's par at 13.3, or total return, that's selling at the high PE of about 18. I think I am looking at the kind of stock that has the potential to improve the roundtable portfolio. The banner across the bottom right there is coming from Manifest. Manifest gives Adobe an 81 quality and a par of 16.7. I think that all of these numbers, whether it's Value Line or Manifest or my own analysis, I think they're all playing real nicely together in the same ballpark. And I am just suggesting that another $1,000 of Adobe might be a really good buy at this particular time.
All right. Sounds good. Thanks, Ken. Matt Spielman also presented Adobe not too long ago, and he had some similar thinking. If people want to go back and review his case study also. All right. TTEC Holdings.
Yes,
New one for Psi.
or as the company says in their, I think it's at the beginning of their presentation, TTEC Holdings. So we'll be talking about TTEC, and certainly Adobe is a well-known company. Adobe, I might even go so far as to say, is a star, but TTEC, if you look at those potential returns that Value Line is looking at, would be more like a superstar.
A Nova.
Yes, a potential 90% return in 18 months and long-term 29%, which tracks what Value Line's bottom line conclusion of patient investors may find this to be an opportune entry point given compelling 18-month and long-term potential. And so let's unpack that a little bit. I was looking for a new stock, and I have a couple of screens saved in my Manifest account, and I was just clicking through a couple of them. Nothing particularly magic about this screen. At one point in time, I was wanting middle growth companies with growth between 7 and 12%. But what this does have built in is one of Hughes McManus's screening things that he likes to look at is nearness to 52-week lows. So that was kind of what caught what I used here, this screen for, more so than the growth side of things. And you could see that TTEC Holdings, TTEC, came up very strong in this, 13% above its 52-week low. So certainly May find some downside protection there potentially, and a very solid par looking forward. Next slide. As I usually do, I go ahead and do a quick industry study and comparison, ranking by par. You see that TTEC is very solid in the information technology services industry. There are two companies with excellent quality ratings and high potential returns: Fidelity National Info Services and TTEC. And I chose TTEC primarily based on those areas that you see: a little bit higher growth, lower projected PE being relied upon to get that growth. And again, in this time of market uncertainty, I like a little bit of extra EPS stability, although in this case, nothing wrong with the 79. And yes, I think it was also on the screen, but Mark has highlighted that Cognizant is both in this industry and shows right here as the next in line for quality in the industry with a reasonably good total return potential. But y'all would not let me buy any more Cognizant. You would run me out of town. So we'll go with TTEC tonight. Next slide. Ranking by quality, you see that actually TTEC falls at the lower end of the quality range. But again, all of these are excellent quality companies. And of those excellent quality companies, which here includes EPAM, Cognizant, I'm skimming to see, are there any other holding? I think Emphasis, it's the highest returning along with Fidelity that we've already talked about. Next slide. Here's a little bit of words about what they do, and we'll have some charts that the company says, but essentially TTEC is in the customer experience business. They are their clients, I'll use the word client for them, the clients are businesses that have customers, and TTEC helps them manage their customer experience from everywhere from finding the customers, marketing to the customer, or tracking marketing. They're not a marketing company, but tracking marketing efforts to the company, tracking employee interface with the customers, serving the customers once they place orders, serving customers in call centers and the like, for service calls to customers, follow up all the way through. And they are a leader in the industry, and they say here they're end to end and digital. In other words, from start to finish throughout the entire customer process. I'll let you read some of the more detailed language there, but I think the bottom bullet kind of summarizes they work in cloud, they work in on-premise servers and hybrid environments. And they have two segments, TTEC Digital, which is kind of their older, more legacy processes, and they have the TTEC Engage, which is a bit more cloud-based and comprehensive. And also, Ken was talking about Adobe and how Adobe interacts with other companies, has partnerships and so forth. I believe you'll see it in some later slides, but what TTEC does for their clients in order to serve the customer of the clients, to enhance the customer experience of the clients' customers, is they integrate a slew of other software companies, to include Microsoft, Salesforce. I don't recall particularly seeing Adobe, but Adobe would be part of it. They seek to bring it all together into a single customer-specific package. Next slide. The two segments, the digital business, as I mentioned, operates contact centers, messaging, CRM, which again is customer relations management software, and then analytics, that is analyzing your customer interactions. And then the engage segment operates more in the cloud and deals with those areas. It's really company engage is more of a front end client to customer interface, whereas the digital segment is a little bit more of the back office, managing for the client their customer interfaces. Next slide. Here's just a little bit of a graphic of the company and their scope. TTEC at a glance. The company calls this is from their latest investor presentation you can get from their website. You see they operate in 20 countries, on 6 continents. 75% of their workforce works from home. I found that rather interesting. And then they're fairly well diversified among industries that they have as clients. Biggest being financial services, then healthcare, automotive, and then on down through other industries. Next slide. And here is just try their visual depiction of the problems that they're trying to address. What they're trying to communicate to their clients and to potential investors, they're calling this virtual customer experience. Basically, customers now want to do everything digitally on their own time, at their own convenience, whatever, wherever, whenever. And TTEC is helping its clients meet the customer where the customer is. Next slide. These are just some specific client experiences, examples of how TTEC has met a client need. For example, in the dining there at the center bottom, helps one of the fastest growing food delivery services establish leadership across multiple countries using their customer experience interfaces. And you can see other examples. Next slide. Here is the slide I was alluding to earlier about all of the software and other sorts of companies that are out there that impact clients and their client or customer experiences, be it tracking, be it interfacing, whatever. And you can see these aren't necessarily competitors to TTEC. These are the software and service providers that customers or clients of TTEC are using. And as it says, it's very complicated and highly fragmented. And what TTEC seeks to do using their Humanify platform, which is one of their platforms, and then what they say integration points, which is where TTEC systems interface with other providers. You can see all of the companies that TTEC is trying to pull together for the client to meet the client's needs. And you see Google and Microsoft, and of course many others, VMware, among many others that are familiar. Next slide.
Just a quick point, Si. Here's an interesting industry study all by itself, and they've captured a pretty formidable set of cybersecurity companies right there.
Mm-hmm. And I had just alluded to the Humanify, which is what they call their cloud product. Excuse me. And again, it's you've heard a good bit about software as a service, SaaS, selling software rather than an end product, but as an ongoing service and subscription. Here they are. They have their Humanify system or product offering that is offering customer experience as a service. Again, tying together all of those parts through partnerships and the like with those other companies. Also, I didn't put the slide up, but I will mention, since I'm talking about as a service, which is a subscription-based pricing model, one of the things that TTEC's management points out, not only do they have subscription-based pricing models, but much of their work also is project-based or consulting-based that is more traditional, fixed prices for a specific project or hourly billing for consulting or project work. So they try and have all pricing models integrated in their cash flow, from the subscriptions to the project-based and the hourly. Next slide. Here's what the company is feels their investment thesis is. This is why you should invest in the company, why they're trying to grow value. They're looking for innovation and differentiated intellectual property. Again, bringing in intellectual property, software licensing, and the like that's different than others. Verticalization, in other words, from start to finish in the process, being able to offer services from the customer experience from the very beginning, first touch with prospects, through service after the client's sale to the customer. That's what they mean by the verticalization. They also seek to go enterprise-wide, the entire company wide for their clients. They do also look for mergers and acquisitions that make sense, and keeping strong finances. Next slide. And here are the judgments. This is just the manifest consensus. You see a high par of 23.1, and that's based on a $7.11 EPS projection. Keep that in the back of your mind as we move into my projections. Next slide. Again, you could see from the Chronicle historical data, the quality is steady and on the upswing, which is always a good sign, and the company is selling at a 4-year high, both relative return to the market, which is the more solid pink shaded area, as well as the red line that I've marked with the green bar that I added here, highest potential return. Certainly looks like an opportune time to purchase a solid company. Next slide. My judgments, I used a sales growth of 6%, which is a little below the 10-year average, roughly in line with the manifest consensus and value line projections. Profit margin of roughly the average for the last 5 years, which also fit the trailing 12 months or so. The profit margin at the end of fiscal 2021 was actually as high as about 9. So it has moved around a little bit. And some of that is pandemic related, some backlog because of the pandemic, but also the pandemic has hurt their profit margins because customers pulling back on some of their sales or their purchases, which is sales to TTEC. And as that shakes out, Value Line expects margins to increase significantly. I'm going to just stick with my average and be pleasantly surprised. And then moving on down to the bottom, notice that $3.36 earnings per share as opposed to the $7.11 that the manifest default, which is more in line with the Value Line that I mentioned. Next slide. Now we'll add PEs and everything to that, and I get a potential return using the high PE, which is very reasonable given history of 33 times. You can get that 21% return, and using the average PE, which is 21.5, which is right in line with the manifest and Value Line PEs of 22. It still gives a solid 11.8% return, and certainly plenty of potential upside there, as you can see with the manifest par. So I think that TTEC is another good company to add.
Okay. Thanks, Al. Would you like me to subtitle that cognizant technology in any way, or sneaking up on it?
Yes.
All right. I'll just quickly go through this a little bit. We're running a little bit long tonight, but I think this is some pretty powerful stuff. Ken brought this to a recent bull session, pointing out one of the Morningstar index products that are out there, and they refer to it as their Exponential Technologies Index. I'll leave you to read it. They're basically looking at environment and big change type stuff in the world. And they've identified a set of companies that is basically involved in some way. And one of the remarks that we made when we presented this as we're looking over this list is, this is pretty darn close to Hugh McManus's vetted list of companies that he continually basically keeps as a watch list or a pounce pile. And it's kind of fascinating, when you look at some of the work going on at some of these companies in healthcare or flat out technology. Pretty interesting set from top to bottom. The one that I'm least familiar with is Guidewire Software, ticker GWRE. They actually make enterprise software for property and casualty insurance companies. And that could be a fairly interesting area to get into. And they have kind of the lowest, at least perception at a first glance, but we'll continue to keep an eye on them. Some fairly interesting companies. So what I like to do with something like this is just basically throw them on a dashboard. Put $100 in each one, can track them over time, and then sort them, much like Cy does, by their projected return. And just see if anything jumps off the page at me to dig in a little bit closer. This group, it's not knock it out of the park growth, 8% down here, but there are some fairly big companies in here. But I do notice here's a 14. That company kind of grabs my attention. Again, fairly strong quality, decent returns, not enough for what we're looking for right now, but perhaps a company that could become interesting over time. Some of the companies up at the top, perhaps even more compelling. Microsoft, as Ken said earlier, compelling, but it is by far our pretty predominant position in the portfolio, so probably wouldn't go after that one. You could stack up Accenture versus TTEC in an industry study if you really cared to. So interesting set of companies. I do think Tyler Technologies is an interesting theme. This one kind of plays along the lines of Maximus in the past for us, and the thesis is right up there at the top. Do you believe that the era of big government is over? I'm not trying to make a political statement. I'm just, if you believe that it is, then you probably move on to another opportunity. I don't see anything that suggests that big government is over based on what I'm watching them do on Capitol Hill these days. These guys basically are at the lower end of the food chain as far as local and state government entities, but there's an awful lot of optimization and customer experience services that need to be done nationwide. So these guys are pretty good at it. Ken and I actually saw these guys make a presentation in Dallas several years ago. Ken, I think we probably should have invested because it was probably back in here somewhere. Probably, and they put on a pretty good show that day. I had one of the company officers making the pitch. So again, that's one that probably goes onto my radar screen. Another one of my favorite sources of ideas, again, I like to look over the shoulders of people who seem to know what they're doing. Eddie Elfenbein is one of those people. He runs CrossingWallStreet.com. He is the manager of the CWS Exchange Traded Fund. And he just today released his 25 companies, they refer to it as the buy list, for the coming year. And you in the audience, you can look down that list. You see a number of companies that have been mentioned a number of times today. What this list of companies says to me is he thinks like we do. And he does also, much like Cy was just talking about, focus in on those medium range companies and looks for excellence in that group. And there's just a whole lot of very interesting companies on here. Middleby, just a bunch. They're sorted, again, by the return forecast on the far right-hand side. So the highest potential ones are up at the top. I'm actually going to go with the third one down with exceptional projected return and good quality, and a company that I think I understand. And it doesn't take a lot of explanation to get to the bottom of that situation at TREX. In fact, TREX is a company that I presented to the Securities Review Committee at Better Investing Magazine probably 20 years ago. First appearance on the pages of the magazine. And it was a pretty decent story then. It's still a pretty decent story now. They make the stuff shown at the bottom. Everybody's familiar with these guys. It's fake wood, but it's good wood, good fake wood for decks and various components in residential construction. As you can see across that bottom slide, qualifies as up, straight, and parallel. It has slacked off in price here lately. Slumped back with many of the companies in that sector. There's a lot of concerns about what's going on in the housing industry. You can see that they did have a bit of a bubble back in 2021 and perhaps are kind of relaxing back into the long-term trend, but the long-term trend is pretty solid. That's Eddie on the upper left, and that's the logo for Crossing Wall Street underneath him. And here's the basic situation. You've got a $40 company. It's basically $1 billion in sales, growing at about 12%. I think you can see that the 12% has been fairly consistent for quite a long time. Really nice sales number. Their margins have been very consistent. You can tell that by, again, the straightness and the parallel condition with the earnings per share line. A little bit of a drop off here, nothing to write home about. This point out here is still in pretty good shape. Again, the overall trend, thinking long-term perspective, that's all intact. So 18% margin, a PE ratio in the mid-20s. The company's been averaging a little bit more than that. So you are looking at a company which will improve the roundtable portfolio by contributing a 20% projected annual return based on the assumptions shown above. And again, a very high quality ranking for the company. They're going to have economic bumps. Anybody in this type of an industry would. And that is the closing paragraph from Value Line in a fairly recent company report from Value Line. And again, they're talking about us here, patient investors. We're not too concerned about what's going to be happening over the next 6, 12, or 18 months. But when you start looking again at that long-term perspective, pretty decent price potential situation. So we'll go ahead and throw a little bit of premium artificial wood on the pile. Yes, sir.
Mark, could I add a very interesting fact to TREX? TREX used to be very tied to the energy oil industry because TREX used to be a product that was made in large part from oil. I know that seems not intuitive, but it's true. TREX has broken the link between its product and oil, however, by moving to recycled plastics. And today, almost all of the TREX material is made from recycled plastics. They don't buy any oil at all to help make their product anymore as they used to. And that's seen as a real long-term driver of margins going forward.
It probably makes them less sensitive to the commodity price moving
Yes,
around. And again, we
absolutely.
presented Len Douglas's slide this afternoon that makes the point that plastic comes from barrels of oil too, so it's still there. But they're not at the front end of that price whipsaw. With that, Ken, I think we can go ahead and go to the audience poll.
Okay, if you give me just a chance, Mark. And here we go. And we'd like you to vote for which of the three you think we should add an extra $1,000 for. We will put $1,000 for Adobe, TREX, and TTEC into the portfolio, and then an extra 1,000 will go in for the one the audience picks as well. We'd like to see 85, 90% of you voting. We're already up to 77% voting, so it's easy. If you're here for the first time, if you have a touch screen, you can touch to vote. You can use your mouse to vote. The only people that have a hard time voting are those of you that might be trying to access this through a phone platform. We're up to 80. There, we hit 90% voting, so I'm going to count to 5 in my mind, and I'm going to close the and I'm going to share it. There we go. So, Mark, we're going to add an extra helping of Adobe to the list, okay?
Okay, was I even close?
Well, you can see the percentages off to the side. Adobe 43%, TTEC 29%, and TREX 26%.
Oh, that's
so
not bad. Not
you
bad.
and Cy kind of split the vote and let a non-majority stock sneak in as the winner. Okay.
All right.
So let me hide this here, and you can go back to. Do we have one more slide, Mark?
Yeah, we've got a couple. Just a quick reminder that we do archive these sessions because we are concerned about the customer experience. Also, this is our customer experience. You can go here on your own time and look at the archive sessions from both sessions in the roundtables and our best
Mark,
small company.
we might have lost the slides because when I'm seeing the.
You're still seeing the poll?
No, I'm seeing the screen that you see when you first try to get into the round table.
Yeah, the waiting room or whatever.
Yeah, the waiting room slide.
Huh. Let me try showing my screen.
There we go.
Yeah, now we can see slides.
How about that? All right, well, see, that was a substandard customer experience moment, and we just fixed it, much like TTEC. Anyhow, you can go here whenever you feel like it. Again, the roundtables, bull sessions. We had an excellent bull session today. That is not here yet. It'll be here within a few minutes. And if you like what you see here, please subscribe, and we will let you know anytime that new content is added. And just real quickly, we are a month out from our next roundtable, which will be on January 31st. I think I got that date right. If I don't, you'll hear about it somewhere. And we do have a AA session coming up in February and March. We'll have more details on that soon. That is a face-to-face session somewhere in the southeastern Michigan area, centered around Troy. and Ken and I are committed to a couple other adventures on the road. We love getting back on the road and getting out with you guys. Cincinnati, end of April, New Orleans, beginning of November, and we'll be firming that stuff up to let you guys all know as those take shape.
If you happen to be, if you happen to be one of the folks that approached me at convention last summer, last June, and wanted us to come visit your chapter, I kind of put a lot of you off and said, why don't you contact me after the holidays? Well, this is almost after the holidays now, so if your chapter is looking for a program, give me a call, drop me an email, and we'll see if we can get you onto the calendar. They don't all have to be in person, although Mark and I are not going to commit ourselves to doing remote things 3 or 4 times a month. So keep that in mind, okay? And with all that, we do have a couple of questions, Mark, that I'd like to handle if we could. This one's for you, Mark. No, this is for Cy. Cy, I have Joe that says that TTEC with a 6% sales growth seems to have a pretty high PE at 33. Does that bother you?
Well, that's a good question, first of all. But TTEC, it's one of those companies that if you look at history, that's what the market has been willing to pay. I even went back, the 33 comes from the average of the last 3 years, because actually 5 years ago it was 200 and something was the high PE, and 4 years ago it was 50 something. So taking those out gave me the 33-ish average, and of course PE, and of course that plus the 10, which is the fairly recent low PE, gets me around value line and manifest 20 average, 21 average. So that's what I was really looking at. But even going back, looking at a 10-year history, I think the average PE, excluding the middle 3 years, because again, they were extremely high, is still about a 27 high PE. So, and none of that, and all of that is at a 6 to 7% growth rate. So that's what the market has been setting its valuation of TTEC.
Phil McPherson says that he notices that Value Line has its long-term debt at 63%. Is that causing anything to register in your mind about being too much debt?
I do not own TTEC, and I do not follow TTEC closely, and did not have a chance to dig into what the specific acquisition was, but they made a large acquisition last year, 2021, which is what boosted that debt, and Value Line is projecting, and the company as well, projecting that to be paid down pretty rapidly over the next 5 years. And interest coverage, which you can mention with respect to Adobe, interest coverage, I think Value Line has it a little over 17 times. So that's pretty solid. And the debt, while I believe at least half of that debt is due within the next 5 years, none of it's due right now. So they've got some time to pay that debt down. And they already have started, and Value Line and company projects that they'll continue to do it. So again, a good question, but I think we can trust management on that.
Thank you so much, Cy. Mark, I think I've pretty well kept up. Cy, thank you for helping in the questions box during the evening. I think we've kept up with most of the questions and got them answered. So if you don't have anything else, it's time to wish everybody a happiest of New Year's. Don't do anything crazy out there, folks. And we hope we'll see you all again on the last Tuesday of the month. And Mark, you are right. That's the last day of January, January 31st.
All right. Well, take care out there, everybody. Everybody be careful and safe and enjoy a wonderful celebration of hopefully a stronger year for the stock market.
Amen.
Thank you so much, Cy. Thank you so much, Mark. And to you in the audience, thanks for showing up. We need you to do our thing, and you don't disappoint. Thanks a lot, folks. Good night.
Good night, everybody.